On the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call, Bonds versus Equities. I'm Todd from FIIG Securities. If you have any questions on the share or bond market, we'll be able to answer on the bond market. Please pick up the phone, call us 1300 30 34 35. The email yourmoney@skynews.com.au. Joining me tonight on the panel is Sue Wang from Mercer and Steve Lambert, who is from the NAB. Welcome.
Thank you.
Have you had a good week?
We have. Yeah.
I've had a week's holiday, which is fantastic.
Good for you.
Came back to the show the October long weekend. That's a commitment. But when I went, we were starting to come to grips with the fact that the US was shut down. It was, the week leading up, it was disaster. Then it was, it's okay. Now I've been away, and I look, and I rang the guys at work and said, what's happened? Nothing.
Yeah, nothing, yeah.
I mean, isn't it surprising that there's been the slow squeeze hasn't had any dramatic effect?
Well, particularly when you think about what happened in June and July.
Yeah.
Mark, with the FOMC, with the talk of the tapering, and then this time it's almost been somewhat of a non-event, really.
It has been. Steve's right. When you have Bernanke talking about something and then the market sells off in such a rapid manner, and you're trying to manage the expectations, has it been surprising to the chatter at Mercer saying, isn't it interesting how the US has just been so limp in its response?
It hasn't, because if you look at, I guess, the last 11 or so examples, or 17 examples of shutdowns, they've had fairly limited market and economic impact. But to be fair, the vast majority lasted no more than, say, 3 days. Well, we're well and truly into the fourth day now, and the market's starting to get spooked. So I would say if this drags on for another week, we'll increasingly see volatility next week.
I agree. I don't think it's even into next week, because I agree. We've seen this multiple times. I remember a trip a few years ago. I wanted to drive around the Shenandoah Valley. Yep. And they've got this very famous scenic parkway. Couldn't even get on it because it's a toll road.
Yep.
And it was that day. It was shut for 2 days. So this time, I worry about into next week. Is that this drags on over the weekend, drags on a Monday, Tuesday. I think the markets will start getting spooked.
But there doesn't seem to be any sentiment around trying to get a coalescing of ideas. It seems to be the Tea Party fracture within the Republican Party saying, well, we'll hold everyone to ransom. It doesn't seem to be that they're moving across that aisle, does it?
Doesn't seem to be any incentive on either side to really come to the party. I mean, the thing that's really going to force them is October 17, when they really got to raise that debt ceiling. The idea of a possible US default is unfathomable at this stage, I'd say.
Yeah. Well, I think the other thing is, you think about, you've got the debt ceiling issue, and you've also got this whole tapering. The tapering debate and what's going to happen there, it's still sort of hanging around there in the background. So you've got the closure of the government, you've got the tapering debate, which is still there, and you've got the debt ceiling. So all three, and what is the combination of those three, and how it's all going to pan out? I think it's.
And when do they have to have the debt ceiling in your mind? When do they have to come to a resolution on that? Do you think it's October 17, or does it need to be earlier to be able to get it to legislate for it? If you get what I mean, it's not easy to say we're going to do it and then it goes into October 18. Do you think they've got to try and get it done next week? Is that the sort of scenario where you'd imagine they have to do it?
You sort of think so. I'm not an expert on the process in the States, but you'd have to think that, as I say, the markets be looking for a sign, not just kick the can down the road again.
Yep.
What is the process around this?
And I guess it's hard to understand what the effect on the GDP of the economy will be. In terms of, the consumer's been the biggest driver in the GDP experience, and by that I mean, and they normally are, but the government's stepping back through the fiscal drag, saying we're not going to do as much, we're going to expect you, the consumer, to do more. And then you, the consumer, had to have interest rates at 0 and mortgages at 3.5% before you moved the dial. So you were saying that I'm naturally conservative, and now we've lifted mortgages unintentionally, and now we're going to give you a furlough. My brother-in-law was supposed to arrive here next week. No chance. Can't get on a plane. Just not going to happen.
Yeah.
You've got to imagine that will, over time, affect all the airlines, the Boeings.
Yeah, it's just
but the growth argument's interesting. Like people have done some consensus estimates. They reckon for each week it drags on, it takes 0.25% of Q4 GDP.
Yeah.
It doesn't seem like a lot, but when you imagine that Q4 GDP is only expected to be 2.5%, then 25 basis points every week is a fair bit.
Yeah.
So how are your clients reacting? And I understand that it's been very benign, but are your clients talking to you and saying, what are strategies around how to manage all this sort of stuff? Is industry super funds, all the different big clients, are they showing some concerns yet and talking to you, or do they, and yourself, Steve, so starting with you, Sue, does any clients respond yet, or are they just, it's over there?
Happy to report, have not had a concerned client call yet, but I would expect that if this drags into next week and we see volatility, it will certainly start to impact their confidence.
Volatility hasn't gone up at all, so
no,
what are your
in
clients?
fact, if anything, we saw credit spreads probably in the domestic market actually probably tighten a little bit. Not a lot, but tightened a little bit this week. So I agree with Sue. I think the other thing here in Australia, given what we were just talking about, what are people on school holidays like yourself, Mark, and we've got a public holiday on Monday, and we've got the fleet in town, so there's a lot of other things.
And the footy.
And we've got the footy, absolutely. I'm not sure about that one, but you're absolutely right.
I rang the stockbroker that I deal through, and I said, what's happening in the markets? He said, nothing. He said, it's nothing. And normally the equity guys will always spruik a reason. And I said, why? He said, no idea. He said, it's confusing me. And it's a big equity house. He said, it is such a strange experience to participate in. So I don't know that there's an easy answer, just to sit and wait. The idea seems to be that all the stocks that are a little bit less liquid and all the bonds that are a little bit less liquid, everyone's saying, we'll just get rid of those ones.
Yeah.
So if I look at a portfolio, I've got that miner, that specky or that mining resource, I'll move that out, or I've got some of this debt, I'll move that out and just go back into the CBAs or that seems to be the theme, that the cautiousness. I mean, as you said, some of the interest rate movement hasn't been significant. Since the taper, has that surprised you, that the fact that interest rates, the non-taper, in September he says, I'm not going to taper, interest rates haven't really rallied, have they?
I think it's
Smalls, but not...
Yeah, smalls. Yeah.
Based on expectations that eventually there will have to be taper, whether it's December or early next year, it's coming. So
it's still the volume, isn't it? There's still the process of the tapering. All this is yet to be sort of worked out. I think it's still some way in the future. It's interesting though. I've just come back from the States. I was in the States last week and seeing some clients mainly in the northeast. And New York was a zoo. We had the UN in town. You had the Iranian president and Obama was in town. So the whole place was basically in lockdown. But interestingly, the sort of discussions you have with our clients around what was happening in Washington was, well, it's just another sideshow. It's really interesting. That was there in the States with what was going on. What didn't have a lot of traction with a lot of people even over there.
And it's surprising that there's no elevation to the king has no clothes. There's none of that experience where they're saying, you know what, this really is quite a bad situation. It's more about, oh well, this is just the way it goes. This is just what they do, which seems to be strange when you looked at the way they judge other people in terms of the Chinese. You've got to get your house in order. Everyone's got to get themselves in order. And you look around and say, you can't pass a budget.
I guess there's a sense that you think the US, when it comes to the crunch, will get their act together. There's still that belief in the market.
Yeah.
And is that surprising?
Well,
biggest detonation in the world, you think they have to get it together.
Eventually.
Yeah.
But as Sue said, I mean, you said 17 times. I wasn't sure. I wasn't aware it was that
17
many times.
since 76 or something like that.
Really?
Yeah.
So.
But is there a sense? I mean, I just think that what the key to all this is the Tea Party piece. And they're newly elected representatives, and they haven't been tested. So to your point, 17 times that all works. Back in '94, Gingrich got hurt. They don't care. I'm new, I'm going to try it my way. That guy spoke for 21 hours. And it's all a precursor to, I want to get more votes as a Tea Party candidate for the presidency. I'm going to be the Republican standard bearer on that far, far, far right. And it just seems to me that they're thinking about their long game politically, but their short game, they don't care. And they sort of got it right. When they said the fiscal issues, put in the sequester, Bernanke said don't do it, it'll really crush the economy. Obama wrote something that no one would sign. They signed it, And they've been proven somewhat right. The economy has continued to improve, and they've got rid of a whole range of different, programs that they didn't like. So that seems to be on their side. They'd be happy. We'll see in a week. We have to leave it there. We'll go for another quick break. We'll be straight back with our panel. You can call us 1300 30 34 35 to talk about East or Manly. And the email is yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is Sue Wang from Mercer and Steve Lambert from the NAB. They're here to answer any of your questions, so pick up the phone 1300 30 34 35. The email is yourmoney@skynews.com.au. Sue, I just want to talk to you first about, let's take it back a little bit, about Mercer, because you were on a month or so ago. So can you just, for the new viewers, because there's lots of them, can you talk about what Mercer is and the role you play at Mercer?
Sure. So Mercer is a global sort of investment advisor, and my role there is mainly to advise on fixed income investments of my clients, predominantly managed funds. What we've been really looking at lately is the types of strategies and fund managers that will deliver for clients in this fairly low yield environment. There's not a lot of coupon income to be earned, interest rate risk is rising, and so we're really looking for managers to be more dynamic, more tactical in their positioning, and to be opportunistic when they see opportunities in the market.
So define dynamic. What do you mean more aggressive with futures? Because we had Steve Goldman on last week. He's from Capstream. He was saying we're much more aggressive, or not, aggressive is not the right way to describe it, but active with the futures market, because we're talking about the idea that what's the value add? Now, if I buy a direct bond, I own it, I might hold it to maturity, but Steve's saying, well, we start selling futures. Is that what you mean by dynamic, looking at those sort of strategies, or do you want them to do a little bit more intricate piece?
Dynamic just simply means I expect them to be watching the portfolio much more closely and be putting on trades or decisions at a faster clip that they probably would normally do, and probably more trades. I think in this environment you don't really want to be bogging down your portfolio of one or two high conviction positions. You want to be really spreading them out, and I think what Steve was talking about, and I know Steve well from Capstream, is just the preference to use the futures market, given its liquidity. Yeah. Liquidity is paramount in these sort of concerning and troubled times, and he's probably just using that market to more easily put on his positions.
And does it make sense to try and shorten duration? Not that you want to give an endorsement to anyone, I'm not asking that, but
Sure.
Does that make some sense to say, well, we don't know what's going to happen, we don't know who, the other one we forgot was the new Fed governor. We don't know who the Fed chairman will be, we don't know what the taper will be, we don't know what the debt...
A lot of unknowns.
So because of the volume of unknowns that are known unknowns, does that make sense to just try and shorten duration?
Well, most definitely. I think the other good reason to shorten duration now is you're not really paid that well to be taking a lot of interest rate risk.
Paid in terms of, because Steve gets paid well enough, but in terms of the return the investor would get.
Yeah, and I guess the amount of uncertainties that we've just spoken about could easily be moving rates, certainly in the longer end, quite aggressively. And so we think that just for that capital preservation, which is really what clients are looking for in their bond portfolio, a shorter duration profile probably makes sense now.
Yeah, for the viewers at home, we had Nick from Aberdeen on a few weeks ago talking about duration, about the fact that duration is the longer end. If you have a movement that's negative to your position, the longer your investments are, the worse it'll have on you. With the interest rate environments that Sue's talking about, low coupon, low returns, what are we seeing in terms of issuance? As a guy that's a very senior job at the NAB, you'd be seeing a lot of both corporate banks. What's the trend?
Yeah, so there's been a lot of issuance over this year. So there's two things, I guess. One side is, we have seen low credit growth in the domestic market. So in that sense, the demand for more money is just not there. So there's not a lot of new refinancing or new bonds being issued for new activity. But there's always refinancing in the market. So this year, say in the syndicated loan market, say the first 9 months of the year just finished, it's about the same sort of level as last year. A lot of that's refi. What's been interesting though, and it is driven largely by the level of interest rates, the outright level, there's been a lot of corporate bond issuance, both domestically and we've seen over the last month or so from Aussie issuers into the US and also into Europe. And the other bit that's really picked up, which we were talking about earlier, was the residential mortgage-backed securities. So that's also been a very big use.
So let's talk about first the RMBS, the residential mortgage-backed securities. Why is that picked up so much? Is it because of the property market in general, or is it because the quality of the assets? People are saying, I like the return for the quality of the assets. Is it a combination of both, or is it just one?
Yeah, I think it's a few things. I mean, I would say, so the market this year for this RMBS, and RMBS for the viewers at home it's a type of bond which is ultimately secured by mortgages for residential mortgages, and it's a very common way that a lot of the non-bank financial institutions fund themselves. So a lot of the Pepper home loans
and credit unions,
etc., like that. So two things. I mean, definitely the quality. Aussie RMBS in particular performed very very well since 2008. Yeah, and they're probably one of the best performing residential mortgage markets in the world. So that's the first point. Second bit is, even within the market, lending standards have probably got stronger since 2008. The companies themselves have got stronger balance sheets, and their lending standards have got higher. So quality's there. And the second side is, I think you're actually right, Mark. There is a lot more lending going on. I mean, it's probably one of the brightest sparks in the banking industry over the last year or two. And that's been where the growth has been in mortgage books and lending for housing. It hasn't been coming from lending into business for the last few years.
And with all due respect to the banks, and I'm not trying to take the mickey out of the banks, but I do feel that it's a consequence of the Basel III, the way you've implemented. It's this classic 2008. All the politicians said, we want to, the US, they called it went into the Main Street, it went into Wall Street, didn't go to Main Street, all the money, bash the banks. Then they brought in all these rules that said, you can't take risk. And so you said, okay, I won't take risk, I'll just do mortgages. And people were saying, we're sort of unhappy that, you're not performing in the way you were supposed to, so then you cut costs. My idea is that there's low credit growth. You can't lend to a lot of businesses because of the restrictions on Basel III. Is that a...
No, I don't think that's right. I mean, certainly at NAB, one of the things that NAB internally we've been really proud of is through the crisis we just kept lending, and we certainly looked at the sorts of risks we want to take. Absolutely, that's just a normal practice within banking. But proof points around that we continued to lend. We didn't pull out and just continue to lend in the domestic market. So it's actually the supply side for lending for businesses is there. That is not an issue.
Then why is it the low credit growth?
Because I just think there's businesses have delevered since 2008, and they themselves. Yeah, they themselves haven't seen the opportunities, less demand. Yeah, it's not a question of no demand, it's just less demand.
That seems interesting, because I was looking at an article Jonathan Shapiro was writing about what FIIG did with 4 new issues, and I get all that. It was good for us to have that. We didn't pay him. He just wrote this up. And we had all these non-investment grade issues. So the last one was where we did a bond that we were able to produce almost 8%. Now that seemed to be for cash converters. So I think that's a $500 million company. They produced a $60 million bond. They almost paid 8%, and they just said we just couldn't get it worked out with the bank to get long-term debt. Now maybe that's just anecdotally one piece, but maybe there's an element between the top 100 to the next 100 down that maybe can't get access to that long-term funding. I
think there's always an industry element. Yeah, and there's always stories with any company, and different banks will have different views on different industries, and I think we've talked once before around how banks think around credit risk, how we think about it at a company level, how we think about it often at an asset level, how we think about it across an industry. So different banks will have different views across industries. But I've actually seen nothing to support the view that it's a problem on the lending side.
And it might just be a consequence of the bond market expanding. People just use it. They would have issued equity, but they'll now issue debt, which is always a good thing for us in the debt world. We'll go to another short break. We'll be right back. Please feel free to call us at 1300 30 34 35 and email your money at skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. My name is Mark Todd, and tonight I'm joined by Sue Wang from Mercer and Steve Lambert from the NAB. They're here to answer any of your questions. Feel free to email or call. The number is 1300 30 34 35. The email yourmoney@skynews.com.au. Sue, I wanted to start with you. Without talking specifics, industry super funds come to organisations like yourself because they're enormous organisations and they're looking for some guidance around how to adapt to the different changes. Self-managed super funds, 500 billion, 670 a month open up. There's thousands of people looking to take control of their own funds, and thank God, because they watch the show. But industry super funds want to try and win those guys back. So what trends are you seeing in respect of how they approach the self-managed super fund space?
Well, I guess, and I completely with you, it is, as my colleague said to me today, it is too big to ignore that part of the super landscape. And I think the key trends I'm seeing is the fact that we have increasing younger self-managed super fund trustees, and which means that we've got quite a few sort of funds that have balances that are quite small, under 150,000. And how you manage, I guess, a younger trustees and smaller balance is quite different to an older, more established and wealthier trustee. And so what I've been working on is as parts of self-managed super funds that they themselves have told us that they would like guidance with. They want to increase diversification. They want to have the control to pick their equities. That's been very, very clearly stated in all the surveys done. But what they want in the bond side is guidance to how they can get better diversification. And they understand that they might need to go global. And that's going to be hard for them to do on their own. So at the moment, they've been using a lot of TDs, but as the TD rates come down, they're trying to look for sort of high yielding areas they can still diversify. Hybrids has been popular, but as we know, quite a concentrated portfolio that self-managed super funds have, and probably the need to probably add some even more sort of defensive bonds into their portfolios.
So just on that, I'm interested on the on two pieces, I guess. There, one is definitely the education piece. I mean, we've talked about this a lot, Mark, on other shows, and one of the big things we've been trying to really try to take a bit of a lead on is trying to get more education out there, particularly around bonds, because everyone seems to believe they understand about equities, but bonds are this is not enough data, perhaps. Or, so, how do you think the super funds could potentially provide, that sort of, as part of a broader group, trying to provide education out there to their existing members around bonds? Do you see that?
I think certainly whenever we've reached out and offered advice or just guidance and education, it's been well received. Most of them seem to think that it's, my advisor will help me pick some hybrids. That will be enough. Look, I'm not saying that there's no place for hybrids. I'm just saying I think that they probably need a bit more diversity in that part of the portfolio. There is a bit of a fear. It is not as easily understood for most as say equities, and because of the lower return nature of the asset class, they probably dedicate less of their time and effort to learning about it. But I think as they've seen certain TD rates come off, they've been interested in learning what sort of other facets they can explore.
Let's talk. I agree. Education is the key to all of it. So, and everyone thinks I'll buy a hybrid. ASIC came out and said, other people who are selling hybrids, selling them in the correct manner. I mean, that's broadly it. And then all the people who were saying, I just buy that because I thought it was a debt instrument, have now started to try and work out how to get out of that or sell that or whatever. And everyone's been critical of TDs. And without wanting to put you on the spot, there is an element that's the differentiation between the absolute rate of a TD and the rate at which we call the spread. And the spread's been quite high. It still continues to be quite high. Is that a fair assessment? Have I got that one right, Steve?
So, I think two bits. I mean, one of the reasons you hear on the news a lot around what's happening with cash rates and the moves in cash rates and what the Reserve Bank wants to do around that is because that is the instrument that basically the government tries to, or the Reserve Bank tries to influence, which ultimately affects the rest of what we call the yield curve around the curve. So most things are sort of, if you like, you can compare it to the cash rate.
Anchored by a cash rate. Anchored
by the cash rate, and be that a government bond, which may actually trade below a cash rate, or depends on where it is along the curve. So I think that's the first bit, is that. And typically in Australia, bankers like myself, we would typically look at two different curves when we price things, you either look at the bond curve, like the AAA Australian government bond curve, or we look at the swap curve, which is sort of broadly. And most bonds in Australia would trade, to a spread above either of those. And it's sort of the same thing if you think about on a deposit. A deposit trades typically at some margin to the cash rate, or the swap curve, whichever
and for the viewers at home, just to interrupt, the swap curve is a synthetic curve, so it's the pricing of cash, and it's not just that the cash rate's at 2.5, it's where will cash implied, where is the expected cash rate 5 years from now. So that's the swap curve that Steve's talking about. And what he's saying is that when that implied cash rate comes to a certain number, he'll look at the borrowing costs subject to that number. So if it's at 4%, he might want to borrow a little bit less than 4% or whatever it might be.
I think that the point, it goes back to the question you asked earlier around Basel III, and Basel III is a global regulatory standard. And it's the third of its kind, if you like, since the 90s. That's hence Basel III. And the reason it's Basel is because it's set by the Bank for International Settlements, which is the central bank for central banks, I think is typically the way it's described. And they're based in Basel, which is in Switzerland. So Basel III basically looked at two things. One is around capital. How much capital should banks hold to support their various activities?
So how much money have they got in their bank?
Yeah, exactly. How much shareholders' funds, things like that.
Funds.
And the second bit is around liquidity rules. Again, we've talked about this before, which is basically how liquid is a bank's balance sheet. And the reason, really the spread is still very attractive on deposits is that the Australian banks, as we talked about before, want more deposits and therefore they bid up for them.
They're relatively attractive, but we can see other people getting different returns or saying the absolute number is not good enough for them, so it's just a question of where they go. Do they go straight down to equities and take the greater risk, or do they move up the curve and say, okay, well, I'll take a little bit more risk but slightly better returns? We'll talk about that in a second. We'll have another short break. Feel free to call 1300 30 34 35 or email yourmoney@skynews.com.au. We'll be right back. Welcome back to the show. If you have any questions on this October long weekend, email on Tuesday. The phone number is 1300 30 34 35. The email, as you know, yourmoney@skynews.com.au. Guys, I want to know what you're worried about, and the thing I want to know about is the data point I just gave you: 500 billion in the self-managed super funds, 670 every month. What worries you about that sort of cohort, if you like? I can start with you, Steve. What's your concerns about that sort of?
Yeah, my concern is just it's not the number, it's not certainly the amount of money in self-managed super. It is this education piece that we talked about before, and making sure that people have got the right knowledge out there to be able to manage their money, because ultimately this is a nest egg for retirement and for to maintain a lifestyle through their life. So it's the education piece.
And the regulators are worried about it, because if they got it wrong, they can see that the government will have to ultimately sweeten the pot by taxing people and saying, look, we've got to pay the pension because people haven't got the money. You picked up on that as well, haven't you, the way the regulators come out saying we're worried about property?
Yeah, I guess RBA's come out and hinted they're worried about investment in hybrids and maybe leveraged sort of real estate assets as well. But I guess the biggest concern is around, are they knowledgeable enough, straight back to the educational piece, to be combining the right mix of assets for themselves as they age? And look, we all understand the need for control. We all want that for ourselves, and the desire to pick individual stocks. I think that's perfectly fair. It's just that does result in many cases quite a concentrated portfolio, and I guess a lack of concentration in the other parts in terms of the more defensive and say income generative parts of their portfolio.
Do you think it's concentrated because they're starting with not enough money? In other words, I've got a self-managed super fund, I've got $200,000 and I've put $150,000 into CBA, and all of a sudden I just don't have the breadth to be able to diversify enough? Is it about the size, or do you think it's just about the experience? They just don't know how to build a diversified portfolio?
I think there's a bit of both, but as I mentioned earlier, that there's an increasing number of, I guess, younger self-managed super fund trustees. Balances are small. And when the balances are small, I think you need to worry about the diversification even more. And it'd be harder to achieve.
There is also in Australia a cultural bias towards different asset classes.
Yeah.
Absolutely. And so that is just a reality.
Property and equities.
They've been calling it the love affair with equities that we've always had.
Yeah, that's right. I mean, Steve, the RBA came out and said they were concerned about the property piece. You know, what was did you look at those numbers and come up with anything?
Yeah, I did. We had a look at that data in the week, and it is interesting. Without a doubt, within self-managed super, property has grown, but it's grown from, I'll throw out, it's around 12% to around 15% over the last few years. So it has increased as a percent, and we are talking about large absolute numbers, right? You know, versus 500-600 billion. But within that, most of it is actually commercial property. That was the bit that surprised me. I had a lot of questions offshore around this as it was sort of hitting the press a few weeks ago, and I think around 12% of that 15% of the total is actually in commercial property. I think about 2 or 3% is in residential. So this sort of linkage that some commentators have had to the, what's been going on in the domestic residential property market over the last 3 or 4 weekends and clearance rates, etc., to self-managed super. I'm not sure I'd necessarily draw that.
So I've got 2 questions. One is the people who were asking you about it when you were overseas. I take it they were investors who were buying bank paper from not just the NAB but from all banks. They buy bank paper. They're worried about that.
They were basically very large US institutional investors that are always thinking around trends in Australia. They're big investors in Australia.
And if they're looking at those big investors are looking at trends, when we're looking at the self-managed super fund buying property, are we presuming that the self-managed super fund is also borrowing money from the banks to buy that property? So they're putting a deposit down via the... is that the presumption we're making? Self-managed super fund puts money down and then borrows some money?
That may be the case.
And so my leading question is the bank would just continue to, if it's on a commercial property, would just use normal commercial business sense regardless of who the investor is. Yeah. The credit's got to be right. You've got to be at the right ratios.
Yeah. The banks typically look through the structure to the underlying asset and say, right, well, does this stack up on its merits?
And I suppose going back to the investors that you're talking about, is there a trend around them being worried about the property market? Is it because we always hear this? We always hear short the property market, it's going down, it's completely a mess.
I think offshore investors out of Europe and the States in particular, every time you go there, you get questions about the property market in Australia. Now, possibly not so much last year than the 3 or 4 years previously. And why is that? Well, if you're in London, number one, you always like to sort of hopefully find something bad about what's going on down here. That's the first bit. The second,
can't help themselves.
They can't help themselves. And the second bit is fundamentally, they've seen huge property price moves, from peak to trough, 50% sort of drop. So. And at different times, the Aussie market really does look overvalued on certain standards. But you have to go back to basics and try to understand this is the nature of our economy. We've got people coming in all the time. We're growing. We got people need to live somewhere. And it's actually we still got an imbalance.
I mean, because
absolutely.
And the stock of desirable housing is limited.
It's limited,
right?
Yeah.
So
absolutely. You go to the States and the housing is so cheap. I mean, 2008 was incredibly cheap, but it's still incredibly cheap. Maybe East Coast, West Coast, it's starting to pick up. If you want to go to Kansas, you can buy a whole village.
It goes back to the stock of housing. They've got a large stock of housing that's literally unused at this stage.
Yeah, I mean, I think, look at Detroit. They've just bulldozing that place down, so it's hard to understand why they would then look at people paying multiples of millions of dollars, and people continue to do it. So it's hard to explain, but it must take some practice. Having to go there all the time and saying, well, this is the story now, it's the same story.
I think most Aussie bankers who go overseas have that story reasonably down pat. They try to explain what's happening in the States.
Steve, the NAB's been at the forefront of the corporate bond market in terms of trying to get it out to the people. You've got the institute down there in Melbourne. You're trying to work it out and trying to get people engaged. How's that going? How's the evolution taken?
I think it's been pretty good in the sense that it's been 2 or 3 years probably in the making. We've been trying to been talking about this a lot. It's becoming very mainstream, I think, in terms of. It's not uncommon to get to a conference now, and it's one of the key topics is talking about the corporate bond market. And I think the other bit is some of the discussions around what will be the next review of the financial system. It's rare that probably two things come up. One is it shouldn't just be about banking. It's not about banking. It's around the financial system. The review, and we haven't seen any terms of reference or anything like that yet. But I mean, that first bit is. Typically, it's not just about banking, so it's going to look at the whole industry, including probably super. And the second bit in there is typically people link infrastructure and the bond market and the linkage between them. So I think in that sense, it's starting to become a bit mainstream. So we have to find something else. So we have to
get something new to get another show.
Have to keep working on solving the problem.
We'll have to leave it there. We'll be right back after a very quick break. We'll be just back in a moment. Welcome back to the Bonds and Equities edition of Your Money, Your Call. We're still taking calls. If anyone would care to call, anyone. Mum, can you call? The phone line, 1300 30 34 35. The email, yourmoney@skynews.com.au. Let's talk about the corporate bond market. There are a lot of people who want to have a seat at that table, and for an array of different reasons. Not all of them altruistic. And this is not negative about them, but does the bond market have to be on an exchange? I mean, I hear a lot of people saying, no, certainly the ASX wants product, and I get all that, and that's fair enough. But does it have to be on an exchange?
So the answer to that's no. I mean, most bonds are not listed
on an exchange.
If we're going to have a corporate bond market for the sophisticated investor, do they have to, or should the sophisticated investor start to adapt some of its behaviour around? How it accesses product because it buys product.
I think one of the key things, and we talked about before, we talked about education earlier, but the other big thing that we sort of talk about a lot is accessibility. So for me, the argument for why you should be probably more listed product is around accessibility and around transparency of price. I think that's very, very important. But arguably, you could possibly create a similar sort of accessibility for unlisted products. So when we think about, absolutely, there's a listed story, there's also an unlisted as it relates to bonds.
So the NAB hasn't got a decision which way it wants, it just wants to have corporate bonds into more people.
Oh, yeah, absolutely.
Would that be the same with yourself?
I just want to see... That would fill the gap between jumping from term deposits and cash into hybrids. We're missing that piece in the middle where, good quality Australian companies might want to borrow and, self-managed super funds might like to lend to them.
Well, cash converters are just under 8%. Seem like it's such a great price. I mean, I think those guys are able to pay, and put it inside, whether it's cash converters or SIV or Silver Shepherd or any of those. I mean, there's certainly corporate guys can pay a price, and we asked these corporates, this is what the investor wants, 8%. How can you, justify that? Because some guys say it's too high. And they said, well, the equity guys are going to charge me 12%. So what? Yeah. Why don't I just try and hold more of my company and borrow some money, and it's only $60 million, or they do these smaller issues. That seems to be trying to fill that gap a little bit. But the question becomes liquidity. Where's the trade-off? So how do you view that? How do you value it? Is there a return bias around the liquidity piece? Because as we know, when it all gets ugly, there's no liquidity in anything. So how do you talk to your customers about the liquidity piece and the return they should expect?
I guess liquidity should be valued, but at times I think it's overly valued. Now, and it's particularly pertinent when I've got clients that actually don't have that much need for liquidity. There are parts of their portfolio that are very liquid, and that's going to serve their purpose when the proverbial hits the fan. But then there are also parts that they probably don't need to touch for some time. And this is the area where we think that they can certainly gain a premium. We call that a liquidity premium by investing in something that's not easily traded.
So what numbers are we talking about? If I'm in something liquid, government bonds, 3 to 4%, whatever I'm going to buy, what am I going to get for the illiquid premium? Is it 6%? Am I going to get 50% more? Is that the sort of...
Ultimately depends on the credit quality, how illiquid the actual bond or loan is. I mean, I think Steve would be best placed in terms of some of the syndicated loans, where my clients, the institutional client base, certainly are increasingly getting, their fair share of. I certainly seen a definite illiquidity premium versus traded bonds of similar quality.
Yeah, I think that's true. I think Sue's point's really valid. It really does depend on rate. It is rating linked, but not solely. The other big thing with liquidity is what was the size of the initial issue.
Yeah.
So that's the other bit. So interestingly, in the loan market, quite often the amounts are larger than you'll see get done in the bonds. Yet the bonds are seen as somewhat more liquid.
Yeah.
Sometimes the loan, and that's largely because a lot of the loans just ultimately sit on balance sheets.
Or there are fewer holders of them.
Fewer holders, yeah.
Yeah.
The way I think about it, sometimes I look at the difference between, say, the government curve, so the federal government borrowing versus, say, one of the semi-governments.
Yep.
And that's an interesting one. So that's probably sometimes of, say, 50 basis points, 0.5%. 0.5% higher. And some of that's definitely around
credit risk, perceived credit risk.
Perceived credit risk, and there's a liquidity premium around that.
Sure.
Yeah, okay, well that makes a lot of sense. And I suppose to some extent, when you talk to people about constructing a portfolio, so the viewers at home, if they thought the way you're suggesting industry super funds or all the clients, the various big corporate clients, they should be less focused on the liquidity piece for a portion of their portfolio. That would make some sense, because part of the greatest problem is trying to get a self-managed super fund to think long term. I find that it's hard to say this is a 20-year asset, but it's inflation plus 4%. And they go, well, okay, I want liquidity.
Sure. Firstly, it's rarely going to be 20 years. And if we take inflation example, I think infrastructure debt or infrastructure loans would be a prime example that self-managed super funds or just any super fund should be getting more of. And we're talking about loans that are probably 5, no more than 10 years. So it's certainly by no means 20 years. And we're only talking about a small chunk of their otherwise very liquid portfolios.
What's the infrastructure world look like at the moment in terms of the debt pieces? How do you see that going?
Well, it's definitely flavour of the month. I was just down in Wollongong. I spent the last night in Wollongong, which I haven't spent for many years.
You've gone from the east coast of the United States and then you went to Wollongong.
Yeah, I've seen it all.
Fantastic.
Mark. But it was with one of Sue's colleagues was down there last night, and it was a conference. University of Wollongong was running, and they've got a centre down there of excellence around infrastructure. So there's a lot of big super funds and there's a lot of government as well. So it's flavour of the month. There's been a lot of discussion. Australia leads the world in infrastructure management, funds management.
Okay.
The world's largest infrastructure funds manager is part of the Macquarie Group. IFM must be probably up there as well.
Yeah.
So
they're massive.
They're huge. And so I think. The debate around infrastructure, quite often it's talking about infrastructure investment. And I guess I'd try to draw the distinction between investment on the equity side and the debt side. So unfortunately it's all around infrastructure funding in a generic sense. I try to get a bit more debate around the debt piece.
Makes a lot of sense. We'll have time for a very short break. We'll be right back in a moment. Welcome back to the last segment for tonight, so we'll get straight into it. We have a caller, Shri. You're calling in from Sydney. You'd like to talk about a portfolio, I believe. Shri, you're on. Talk.
Hi, how are you?
Good. Yourself?
I'm good, thanks.
How can we help you?
Okay. I got a property worth about 1 million.
Yep.
I'm out of the job at the moment. It is advisable to buy an investment property or not? My wife is working.
Yeah.
So
that's always good. I always encourage that. I think it's always good if your wife works.
Yeah.
I guess the key to all of these is trying to understand everyone's circumstance, which is always incredibly hard to do. By advising people to buy property right now is probably not, in my skill set. What we are saying though is a lot of people, we want everyone to have a portfolio that is balanced, and I think we've been talking about that a lot around trying to structure a portfolio that will suit your risk profile, your age, and what your long-term goals are. I don't know that if you've got one property you then go and buy another one, but you'd have to get an advisor to talk to you about what's the best process for whatever your goals are, and you'd have to talk to your wife about how long you expect it to work, because that's the hard conversation to have as opposed to the advisor. So hopefully that helps. We're in our last segment, so I have two questions. One is age-based investing. Is it a growing trend? Do you see it happening? We spoke about it last week. You're 40, 50, and they start doing it for you. Is that a trend that you're seeing?
Oh, most certainly. It is pretty much the direction we're headed. You would know that in the US it's very well established, and they call it age-based investing there. We like a different term, we call it life cycle investing, but it's basically the same thing. It's basically making sure that the fund that the member is in, that it changes as the member's situation changes, mainly as their age changes. And I think My Super has completely endorsed, life cycle funds as part of My Super options, and that is really the way that we're heading.
And Steve, who does the management decisions? I'm a younger man. I get X. Yeah. Do I get a chance to look at what they're suggesting for me? Do I know that in advance, or do I just want to hit 50, it ticks over, and they start changing my portfolio? Like, how do we get engaged in that conversation? I want to take greater risk. I want less risk. What happens there? Yeah,
I think. Certainly the funds that we're creating in the initial stage are targeting the disengaged member, but we have very, very clear sort of portfolio structures as to what it would look like at different stages of their age. The most important thing that it's a gradual shift in asset allocation, and not like the lumpy shifts which you might get, and the event risk that might come around with making large changes to your portfolio at key points.
And this goes, we've talked before, Mark, around the issue of sequencing risk, which is when an event occurs.
Exactly. We have to reinvest.
This is how this is tied into
This is how you manage that. Yeah. Now, my second question was, is there anyone you'd like to say hello to?
I do. I want to say a hello to Trinity Vassallo. Trinity's mum works for me, and she's been wanting to know what her mum's boss looks like.
And didn't believe she had a boss. So Steve is the boss at the NAB. That's all we have time for tonight's show. Thank you very much for Sri for calling in. I hope we're able to help you somewhat, especially Mrs. Shree. I'd like to thank Steve and Sue for coming on the show on a Friday before a long weekend. That's been fantastic. Hope you all have a very nice weekend. Enjoy the long weekend and enjoy the rugby if you're watching.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate.